I bet you must have seen in the local dailies or in the news or watched in news reports such as CBK liquidity challenges hampering debt repayment, CBK warns liquidity crisis threatens Kenya's debt, CBK liquidity challenges hampering debt repayment, local insufficient cash flow, inability to generate enough cash flow to service debts, and so on and so forth. And then at the same time, this same CBK has released the prospectus for December 2025 bond auction. And this prospectus is quite interesting. What do I mean by that? Have you subscribed to the channel? Please do if you haven't. My name is Belin and I bring to you quite informative videos with regards to investment options. CBK has released two prospectus for December auction and I would like us to review the silent features of this, and then we are going to link it to the liquidity status that CBK had mentioned, right? So we have an SDB1 2011-30. This happens to be one of the longest papers that CBK has ever auctioned. It was first auctioned in the year 2011 for a 30-year tenor. Now it's remaining with 15.2 years to maturity. And it had a coupon rate of 12% and a tax rate of 10%. Remember, when you have a long-term paper, the tax rate is 10, and the short-term papers, the 5 years, 7 years papers, has 15% tax. So this one carries a 10% tax, meaning that its net coupon is 10.8%. It has accrued interest of 3.92. Accrued interest means that from the last time the interest was paid to the next time, up to the date of settlement rather, the accrued interest is 3.92. The people who had invested in this paper already accrued 3.92 for every 100 shillings that they had remitted on the face value of the paper rather. And previously in NSC, remember bonds are traded in the secondary market. Yeah, so in the secondary market, this paper is trading at a discount. It's trading at 90.3641 shillings for every 100 shillings, okay? The other paper, FXD1 2021-25, was a 25-year paper, which was first auctioned in the year 2021. It has 20.4 years to maturity. It had a coupon rate of 13.92%. So if you invest in this paper, CBK shall be paying you coupon rates at the rate of 13.92%. It equally has a tax rate of 10%, meaning that it has a net coupon rate of 12.53%. It has accrued interest of 1.3388 shillings per 100 shillings. And in the secondary market, this paper is trading at a premium of 108.8497 shillings. You can imagine a 13.92% coupon paper trading at a premium in the secondary market. That is a good indication of how low the rates have come. Why? Because last year a 13% coupon was still trading at a premium as of last year. Now, this year it's trading at a discount. That is how it's a good indication of interest rate risk or how much the market rates have fluctuated, okay? Anyways, let's go to the dates. The important dates for these papers: the bid closes on 3rd December 2025. That's the same date for the auction. And the settlement date is on 8th December 2025. You can see the maturity, 15 years later for the SDB1 2021. And 20 years later for the FXD1 2020-25. In other words, if you give CBK your money now, you have three options. Number one, you go back to CBK for rediscounting. Number two, you go to the secondary market and sell the paper. Number three, you wait for the maturity. All right. Now, can you imagine 100,000 shillings today, receiving it back 20 years later? If you were to buy a portion of land now at 1 million shillings, do you think it would be possible for you to get that same parcel of land at 1 million shillings 20 years from now? Inflation risk. That is one of the risks of investment in treasury bonds that we always need to take caution of. And now that I have mentioned it, how do you mitigate inflation risk? How do you ensure that your 1 million now will still give you the same basket of goods 20 years later, or your 1 million now will still give you the same basket of goods or the same parcel of land 15 years later? You mitigate inflation risk by reinvesting your coupons, by taking advantage of the compounding effect. You give CBK money now, 1 million now, CBK pays you coupons of 12.5%, that is 125,000 shillings every year. You do not consume the 125,000 shillings that CBK pays you annually. You reinvest that money. Grow it until it multiplies or until it doubles. Reinvest that coupon. Not necessarily in the bonds. You can reinvest it in shares. You can use it to invest in special funds. You can use it to invest in ETFs. But reinvest that money. Grow it so that 20 years later, as CBK will be giving you back your initial investment of 1 million, you'll have grown it to maybe 3 or 4 million or even 5 million if possible. Okay. So reinvesting your returns is one of the best ways of beating inflation, and preferably reinvest it in an asset that has the potential of paying you more, especially now that CBK has already given you the advantage of conserving your portfolio. Now look for a growth portfolio, a portfolio that has the potential, an asset rather, that has the potential of paying you more, okay? Anyway, that aside, we have seen that the SDB1 2011 is trading at a discount in the secondary market. So I would like us to do a dummy. What if we invested 1 million at the market rate in the secondary market? On the day of auction, CBK will tell us at what rate it's going to auction these papers. But let's do a dummy calculation using the secondary market figures that we already have, okay? These figures are listed in NSE. We can have a look at them at your own free time. Now, assuming we put a bid of 1 million for the SDB1 2011-30, that is trading at 90.3641 shillings in the secondary market, and it is accepted by CBK at that secondary market price of 90.36. We are going to have to remit to CBK 903 shillings 641. I am not saying that this is the price at which CBK is going to auction this paper. I'm just giving an illustration based on the latest market rate or my latest market prices, okay? So if CBK was to auction this at the market price that it was traded at in NSE, then we are going to have to remit to CBK 903 shillings 641. And remember, coupons are not paid on the actual amount you have sent to CBK. Coupons are paid on the face value. Coupons are paid on the par value. In other words, coupons are paid on the actual amount that you placed your bid. Did you put a bid for 100,000? Did you put your bid for 50,000? Did you put your bid for 20 million or for 1 million shillings? It is that amount, it is that bid amount that coupons are going to be paid at, okay? So we place a bid for 1 million, meaning our face value is 1 million. Face value is, if you're to be given a certificate for that bond, what will be written on the face of that paper? What is your par value? That is how much your investment is worth at CBK, even though you're remitting to CBK 903,000 shillings. So CBK will be paying coupons on the face value of 1 million, meaning that on the 1 million, remember I told you that our net coupon is 10.8%. So on the investment of 1 million, CBK will be paying us, or will be paying you 108,000 shillings, okay? So our absolute return, having sent to CBK 903, what is your absolute return on that? Even though the net coupon is 10.8, your actual principal is the money that has left your pocket going to CBK. Your paper at CBK is worth 1 million, but how much left your bank? 903,000 shillings 641. So that is your actual principal amount. So when you calculate the coupon that CBK will be paying you, that's on the face value of 1 million, is 108,000. Expressing it as a percentage of your actual principal, which is 903,641, then your absolute return is 11.95%. So in other words, if you take the SDB1 2011-031-030, if it was to be auctioned at the prevailing market price or at the price at which it was auctioned in the previous market, remember this, the prices fluctuate every other day. It depends on that particular day's demand and actual trades, okay? So if it was to be auctioned at the last market price, then you'll be having an absolute return of 11.95%, all right? How about the other paper? FXD1 2021, sorry. I told you that in the previous market, it was being auctioned at a premium, 108.8497 for every 100 shillings. So assuming that CBK was to sell this paper at the market prices of 108.8497 shillings as it traded in the secondary market, then it means that for the 1 million bid price, for the 1 million face value, for the 1 million par value, CBK will ask you to pay a premium of 88,497. So you put a bid of 1 million for this paper, and remember I told you the previous market price was 108.85. So assuming that CBK auctions this paper at a premium, because it's already trading at the secondary market at a premium. So assuming that CBK auctions this paper at a premium, you are going to remit to CBK 1,088,497. So your actual principal, the money that leaves your bank, is not the 1 million. It is 1,088,497. Okay? Now, the coupons for this is at 12.53%, net coupons rather. The gross coupon is 13.92, and it has a tax rate of 10%. So the net coupon, the actual money that CBK sends you, is 12.53%. 10% of that coupon, of the coupon, goes to KRA on your behalf. So the net coupon is 12.53%. And coupons are paid on the bid amount, on the face value of the paper, not on the actual amount you send to CBK, right? So in as much as your actual principal, your principal investment is 1,088,497 because it's being auctioned because it's auctioned at a premium in the secondary market, CBK will send you coupons at 12.53 net on your 1 million face value or on your bid amount. Therefore, they will be sending you 125,316, okay? Even though you did not remit 1 million to CBK, you remitted rather 1,088,497. So what is your absolute returns on that investment? 125,316 as a percentage of your bid amount of the face value of your paper of 1 million is 11.51%. Okay? Whenever you have a chance to earn more, always go for more. So ideally, why did I link the liquidity matter to these auctions? You've seen the tenors, the 15.2%, the 15.2 years and the 20.4 years. Now, during COVID, when rates increased, when interest rates increased, skyrocketed, CBK opted not to tie the government to high interest payments for longer duration of time. It will mean that the CBK would have inflated the debt levels for the country for a longer duration of time, which is a bit unsustainable and it's not economical. Doesn't make sense to anybody, including you yourself. If you can borrow at 18% for 12 months, knowing very well that rates are going to come down, and then you go to borrow at 18% for 10 years, tie yourself at 18% for 10 years, I would rather borrow at 18% for 12 months only, and then on month 13, take another loan for 15% once the rates have come down. That's exactly what CBK had done. They borrowed, they issued shorter term papers, 2 years, 3 years, 4 years, 5 years at the higher rates. And now that rates have come down, they have successfully managed to bring down the lending rates on the market rates. They are now stretching, borrowing for longer term at low rates. Why? Number one, they are managing their liquidity. How are they managing their liquidity? They are stretching the repayment terms for the principals, for the principal payment to a longer duration of time. Why? For 15 years or 20 years. so that in the foreseeable future, in the 3, 5, 6 years to come, they don't have a huge amount of principal that they have to repay. Okay. Number two, they are also managing the country's debt level. Why? Because having lower coupon papers for a longer duration of time then means that the interest payment or the coupons that will be payable to us, the investors, will be lower for the next 15 years or for the next 20 years. So it is a good thing that CBK is actually, or the government is actually managing or putting in efforts to manage the country's debt level by having lower coupon papers stretched for a longer duration of time. Okay, that is why you have seen in the daily some people saying, some reporters saying that, or some analysts rather saying that CBK is testing us with long-term papers. We have seen them issuing 5 years, 7 years, and this is the first time that I see them issue a very long-term paper, like 2 of them in the same month, okay, in one auction. Now, I will not be surprised if we have a low subscription to this paper. Why? Because investors are pushing back. Everybody, including yourself and me, want to earn more. Okay, so if they're giving us a lower coupon paper to be held over a longer duration of time without the option of a shorter term paper, even though it's also going to be a low coupon paper, is testing our appetite, our risk appetite level. And believe you me, if these papers are oversubscribed, the next auction that CBK is going to release is going to have an even lower coupon paper and longer term paper, if these 2 papers are oversubscribed. But if they are undersubscribed, 2 things are likely to happen. Number one, CBK could test us again, could push us again, push back the investors and give us another long-term paper, or they could give us a short-term paper and a long-term paper. But certainly CBK is still hell-bent on resisting the investors' demand for higher returns by issuing lower coupon papers for longer durations of time. Are these papers a take or a pass for you as an investor? Now, it depends. At a personal level, these are a pass. Why? Because they are not aligned to my individual investment objectives. However, if I was working on a long-term goal, I'm having my bonds on a mid-term goal, so I'm playing with 7 years and below, okay? However, if I was working on a long-term objective, if I was working on retirement, or if I was going for retirement and I'm looking at having passive income for the longer duration of time, or if I had a long-term objective, then these papers would have been quite a deal for me, would have been ideal, okay? So these are the papers that you take when you're planning on retirement. When you are on retirement, in fact, it offers us a good opportunity to ladder. If you take like a portion of each of these papers, then you stand a chance to earn coupons. You already have 4 months of the year locked in coupons on guaranteed coupon payments or guaranteed passive income. That is what we call bond laddering. You layer your bonds in a manner that you have payments in different months of the year, okay? You can also do bond laddering so that you have papers maturing. You have principal maturing at different times of a period, okay? You can aim at getting coupons that, taking bonds rather, that mature in the year 2030. Say you want to build your home in 2030. So you look for coupons, you look for bonds that mature in the year 2030 or maybe in the year 2029, or you look for IFBs whose redemption structure has a bond payment in the year 2030, bond laddering, okay? So these are examples or good illustrations of bonds that will pay us coupons that will be good for passive income, for long-term passive income. If you want to generate a passive income, these are good examples of bonds that will offer us or that will help us to achieve that investment objectives. If you're in a retiree, if you're going into retirement, these are good examples of bonds that you need to having in your be having in your portfolio, because you are looking at having passive income for a longer duration of time. Okay, imagine retiring at 60 and then putting your lump sum investing part of your pension in this paper that pays you coupons for the next 20 years. It's a good example of a bond to hold, okay? Now, that brings us to the end of today's episode. My name is Berlin, and thank you so much for tuning into your home of financial freedom. Let's meet on the next video.